Warren Buffett has a lifetime of investing expertise and has successfully fostered a reputation of being one of history's best stock pickers. From 1965 through 2021, his firm, Berkshire Hathaway, had an average yearly return of 20.1%, easily outperforming the S&P 500 index's 10.5% return. If you've got some extra cash that's been burning a hole in your pocket, follow the Oracle of Omaha's footsteps and make your money work for you. Here's how. First and foremost, Amazon has been going through a rough patch lately. Investors have grown considerably more wary of growth stocks this year due to inflation and increasing interest rates. Inflationary pressures have also resulted in increased expenses for Amazon's e-commerce sector, and this headwind has coincided with the company's large infrastructure and technology investments, which have harmed the company's profitability. To make matters worse, the company's large expenditures in its e-commerce operation coincided with decreased demand as pandemic-related situations improved in many areas of the world. Amazon's significant decline this year is hardly surprising given the confluence of so many unfavorable factors. The share price of the e-commerce behemoth is down nearly 20%. Thus far in 2022, 29% from its high last year. Despite large sell-offs, the company's price-to-earnings ratio has skyrocketed due to the decline in profitability. What's more, if you were anything like Buffett, you'd want Amazon in your portfolio. Long-term investors still appear to be well-positioned to profit greatly from the stock. Amazon's e-commerce is going through growing pains, but the company's efforts to build its size and infrastructural advantages will most certainly pay off. While the company's online retail business accounts for the vast majority of its sales, it has very poor margins. In fact, it doesn't account for nearly as much overall profitability as Amazon Web Services, the firm's cloud infrastructure division, and that's even when conditions are favorable. However, warehouse and delivery automation have the potential to make the e-commerce industry considerably more profitable in the long run, and this trend might be highly beneficial for patient shareholders. Meanwhile, investors should know that AWS is on the pace to continue delivering profitable growth. In the second quarter, the segment reported 33% year-over-year revenue growth and a 29% operating income margin, and the long-term demand forecast for cloud infrastructure services continues to be extremely positive. Amazon is structured for success, with leadership positions in two promising industries and a stellar track record of innovation and execution. Following up, your next option is going to be Berkshire Hathaway. By making investments in Occidental Petroleum, a provider of energy, and Activision Blizzard Inc., a video game developer that Microsoft Corporation is likely to purchase, Berkshire has had a successful year due to its value-oriented approach and concentration on financing high-quality firms. Buffett's investment conglomerate beat the market in 2022. The five largest stock holdings of the investment conglomerate are Apple, Bank of America, Coca-Cola, Chevron, and American Express. If you invest in Berkshire Hathaway, your portfolio will include exposure to these equities, as well as the company's completely owned insurance and energy businesses and other subsidiaries. The firm also has a large financial reserve to deal with. Berkshire has $105.4 billion in cash as of its most recent report, and holding a lot of money on the sidelines has turned out to be a wise choice given the volatile trading for stocks this year. Buffett now has chances to go deal hunting for stocks and prospective acquisitions, with the S&P 500's index down around 15% this year, while the Nasdaq Composite Index is down roughly 25%. Berkshire's investment in shares typically raises the share price of that firm. Thus, Buying a position in the investing conglomerate offers you exposure to those corporations before word of Buffett's recent purchases even hits the wires. The management team at Berkshire, which includes Vice Chairman Charlie Munger, Buffett, and other new hires who are all aiming to increase your wealth, is of a high caliber, as seen by their track record of market-beating performance. Up next, is Buffett able to predict stock market movements? He confessed that he couldn't foresee the share market in the short run, or based on financial variables like interest rates. Rather, he seeks to acquire firms that would thrive even if the stock market were closed. He is not concerned with daily stock swings and believes that the market exists to help you. Buffett has previously used the metaphor of Mr. Market, which was devised by Benjamin Graham, the originator of value investing. Mr. Market is a fictitious investor who, on any given day, is motivated by fear, exhilaration, and indifference, and approaches investing as a reflex to his mood rather than using fundamental or technical research. And Mr. Market, according to modern readings, is manic-depressive, swinging from periods of optimism to moods of pessimism at random. Mr. Market constantly causes ups and downs in stock prices, but wise fundamental investors are unaffected by it, since they are looking at the bigger, long-term picture. Graham and his students think that investors are better suited to appraising the value of equities through fundamental research and then choosing whether a company's prospects merit a buy or sell of the investment. Lastly, here's one last lesson from Buffett: invest in simple businesses. Many people respect Buffett's pragmatic approach to investing. Take a simple idea and take it seriously, Charlie Munger once said, and that is exactly what he has done. The investor's purpose is to purchase the right sort of company at the best price with the right personnel. Buffett prefers to invest in companies that fall inside his circle of expertise. What matters is not how large your circle of expertise is, but how effectively you have established its boundaries. For example, Buffett considers most technological businesses to be in the too hard pile since the economic leaders moved too abruptly. This is how Buffett dodged being massacred during the late 1990s dot-com bubble and meltdown. A simple business is consequently simple to manage. Buy a company that any fool could manage, says Warren Buffett, because eventually one will. Now, moving on to other news. First up, as recession concerns build, stocks fall, the dollar rises, and bonds fall. Stocks in the United States and Europe fell on Friday. The dollar reached a 22-year high, and bonds fell further as investors worried that a central bank prescription of hiking interest rates to combat inflation would push major economies into recession. The Dow just escaped confirming a bear market as a growing decline in Eurozone economic activity, along with U.S. business activity declining for the third month in a row, left Wall Street languishing in a sea of red. The British pound and debt prices fell further as the UK government announced massive debt-financed tax cuts that will increase borrowing, sending UK bond rates skyrocketing to their highest daily rises in decades. The euro fell to a 20-year low and sterling to a 37-year low, while the dollar rose as the Federal Reserve hinted this week that interest rates will remain higher for longer. According to George Goncalves, MUFG's director of U.S. macro strategy, the Fed intended financial conditions to tighten, and high interest rates were the mechanism to provide a market that investors had not seen in a long time. The Dow Jones Industrial Average plummeted 1.62% on Wall Street, becoming the first major U.S. stock index to go below June's bottom on an intraday basis. However, the blue chip index avoided confirming a bear market by failing to close 20% or lower than its record high, as defined by a widely accepted definition. Up next, Buffett supports the truck with oil stock holdings. Warren Buffett has been buying Occidental Petroleum stock for some years, with recent acquisitions being particularly active. Berkshire Hathaway, the oracle of Omaha's firm, currently controls 27% of the exploration and production company and has permission from the Federal Energy Regulatory Commission to grow its share to 50%. By the end of June, energy equities accounted accounted for more than 10% of Berkshire's invested assets. Energy equities have never made up a significant portion of Berkshire Hathaway's portfolio, despite accounting for over 9% of the company's invested assets in 2008. So why is Warren Buffett investing in a dirty oil firm at a time when everyone is talking about net zero emission goals and sustainable energy? Most significantly, why is Mr. Buffett investing in a hydrocarbon firm when oil prices appear to have peaked? The moat is the solution to both of these problems. There will be no new oil corporations to challenge current companies. Mr. Buffett has sought firms that have a clear competitive edge and the capacity to generate profitability without spending excessive amounts of money to develop. The oil and gas business after 2015 gives exactly what Warren Buffett desires. Lastly, millennials and Gen Z are canceling their investment accounts. According to an Ally poll of 900 investors, nearly 1 in every 5 customers closed an investing, trading, or brokerage account in the previous 12 months, with Millennial and Generation Z respondents closing the most. According to the data, over 40% of those surveyed lost part or all of their investments owing to inflation, while 31% liquidated assets due to fear of losing money due to stock market volatility. However, cashing out an investment portfolio may end in regret. High inflation, stock market volatility, and geopolitical conflict have all occurred in the past, according to Newell, and these factors should not deter you from investing. And regardless of your long-term investment goals, selling when the stock market falls may lock in losses. Alternatively, if you've determined that a specific investment does not align with your objectives, a targeted sale may make sense. Then you can look for other assets that will better suit your needs. That's a wrap for this video. Do you think a Buffett-based portfolio can do well? Let us know in the comments below. Make sure to give this video a thumbs up and subscribe to our channel for more videos like this. See you in the next one.